The fifth way that you can invest your $1,000 is to invest in money market funds. A money market fund is a type of mutual fund that invests in short-term, high-quality debt instruments like government bonds, certificates of deposits, and commercial paper. It's specifically designed to offer stability, i.e., to keep the net asset value close to £1 or dollar per share. It also offers liquidity, i.e., easy access to your funds. And thirdly, it provides income through regular interest earnings. And to give you an idea of current potential earnings, in the US, top money market funds are offering up to 4.89% APR. And in the UK, the average yield for UK money market funds is closer to 4.95%. And whilst someone watching may think, well, 5% isn't good enough for me, it's way too low, believe me, there's always one complainer. I personally think that for where we are today, these are good enough rates because at least you are beating inflation, which is around 2.5% in the US, UK, as well as Europe. So here's how money market funds work. You invest in a fund and it pools your cash alongside those of other investors within the funds to buy short-term debt securities, i.e., you are lending money to short-term borrowers over a 3 to 6 month period. And the interest earned from these short-term loans is distributed to yourself as well as other investors on a daily or monthly basis. Money market funds are beneficial because they invest in number one, high credit quality short-term instruments. Number two, money market funds often offer better returns than your traditional savings accounts. You can usually withdraw your funds fairly quickly without penalties, but of course, this will be on a case-by-case basis, so it's important to read the fine print within the term sheets. And lastly, you get safety in numbers because the fund spreads your risk across different instruments and not just one. And so here are some examples of money market funds to get you started on your research. The Vanguard Sterling Short-Term Money Market Fund if you're in the UK, and the Schwab Prime Advantage Money Fund if you're in the US. Now, you may be interested in the property market, but you don't quite have enough funds to buy a whole property. One great way to get access to the property market without owning real estate physically is the sixth way that you can invest your $1,000, and that is through REITs, real estate investment trusts. Now, this may sound incredibly fancy, but REITs trade the same way as stocks. A REIT is a company that owns, operates, and manages income-generating real estate. Properties like shopping malls, apartment complexes, office space, or even data centers. By law, REITs are required to pay out 90% of their profits to shareholders in way of dividends. And so this means you get a cut of the rent without being a landlord. So how can you buy REITs? Well, similar to how you would buy a normal stock, you would need to open a brokerage account. And what's more is that you can buy individual REITs or you can buy a REIT ETF, very similar to what we discussed earlier, where you have several REITs on the one instrument. And you can do this through brokerage apps like Thinkorswim, Robinhood, Vanguard, Fidelity, or even through your IRA. So here is why REITs are desirable. You receive a steady income through dividends. For example, and this is just an example, let's say a REIT commands a 7% dividend. It means that if you invest $1,000, you will receive on an annual basis $70, which is a nice way to earn dividend income. Also, you get the benefit of diversification because REITs, although they trade like stocks and they pretty much get affected by the same market conditions as stocks, they provide access to a different underlying asset class, which is property. And additionally, you get the benefit of liquidity because you can sell your REITs at any time, just like stocks.